Okay, left, right, out again. Once again, I'm in the vehicle, running around. So the CPI data came out, and I'm not going to use the term inflation. It's a rise in prices. The CPI data is a symptom. It's like a test, for inflation. So it's well over 7%. It topped the forecast, which who cares about the forecast? I don't even care about the exact number, because here's why. Because they're looking at this is a manipulated number regardless. And yeah, the markets, whether it's manipulated or not, everybody seems to believe it. But, what is it? Core CPI was 6% or whatever. Here's the thing. This is only going to get worse, in my opinion. You're seeing a lag in the rental part, which is a significant, the housing and rental portion of it, a significant portion of it. We've talked about this in the past. And that's lagging. That is lagging because whatever they call owner's equivalent rent. We know that rental prices have gone up significantly over the last year, 2 years. It's been steadily increasing, astronomically increasing over the last year or two. Excuse me. But that's not reflected in this, because how they suppress that data. It also doesn't take into account shortages and these other things that are going on that are a result of monetary policy. Here's what the market is doing. The 10-year, like I said, always look at that. Always look at the bond market. That thing hit 2, which is pretty incredible move for the beginning of the year. Now, I could go into what I believe the mechanics are. I'm sure somebody else has a lot more details on this, but to me, I can just, as an investigative mind, look at it and understand why it's getting the 2%. I think the Fed is trying to ease off, and they're not as large a part of the market as they are, and it's allowing these rates to float up a little bit. And we'll see on their balance sheets, because even though they've been tapering or supposedly tapering on that, their balance sheet's still increasing significantly. So that tells me we're still in the market. But okay, let's get off of that. Here's the thing: the market's to me is not down very much. It's not even down like half at the moment, right? And the 10-year hit 2%. That's an inflection point. 2% is like a psychological level, but it's also a level on a future investment for banks, in a sense. But right now the funds rate is still 0. So we will see as they raise it up. There's going to be this inflection point in corporate bonds and just overall larger investment wise, and we're going to see probably see a correction if this 10-year keeps pushing pushing interest rates up, real interest rates. I'm not talking about what the Fed funds rate is. Granted, the banks with access to that window are making money hand over fist when you have this kind of disparity. But what's going to happen is right now, in my opinion, the market's trying to call the Fed's bluff, because here's some number of Fed presidents have been out, right, over the last few days, and they're like, oh, well, we might, anywhere from 3 to 6 rate hikes. They've kind of backed off, and now it's like, well, 3 to 4, and the common parlance to that is quarter point hikes or 25 basis points. And they've kind of backed off, from that whole 50 basis point hike, which that's kind of what we need, even more than that, to be totally honest. But a quarter point basis point hike is not going to do much to combat inflation. It's like shooting a 22 cal at a grizzly bear charging at you. All right. Unless you hit it in the eyeball and hit it in the brain, you're just pissing it off. So, I think the market's calling it bluff. It's like, hey, what are you, 4? So you're saying you're going to get to 1% when we're pushing 7% year over year CPI? And we're seeing, shortages. We're seeing prices rising in other assets, and lower tier assets, or not lower tier, but base, I'll call them base assets that go into the production of other assets. Like, let's talk about like fuel and or just petroleum in general, which goes in 1 to gas and diesel, 2 into plastics and other refined products. So that doesn't look like that's already, it pulled back to 89 and it's back over 90. The WTI. So we're on a whole nother track, and I think the market's trying to call their bluff a little bit. Of course, you have some algorithmic buying, which takes the human aspect out of it. They're just looking at certain parameters of the market and either going to buy or sell, making sometimes little small bits of profit on a daily basis, or pushing up the long-term deal. I don't know where the short sellers are right now. I think they're focused maybe on the bond market, but where are these guys in the stocks? I think they're just waiting. Like I said, there's an interesting pattern developing in the S&P 500 that I believe is a head and shoulders, but that right shoulder, if it pops up too far, then who knows? But technically, which technicals are more of a psychological basis, that's why they work, and that's how the market tends to operate, at least in the short run. It is based off overwhelming psychology, and that could be based on false numbers, as I've just gone over. Like we've gone over a number of times, BLS numbers, the inflation or the CPI data, the PPI data, or specifically the CPI data, highly manipulated. But it's the perception of those numbers that matter to a lot of the investors. Now, like I said, I think they're calling their bluff, because the perception is you're going to get to 1% this year, and we're running at a 7-something% CPI, and it could get worse. And even if food prices and all that stabilize, if the renter's equivalent, portion of that, the 30% of the CPI catches up to that number, you're still going to have an overwhelmingly increasing number over this until we get to the point where, until we get to the point where we're matching these year-over-year numbers. I mean, we'll see. But like I said, I've been hedged on the other side of this, trying to wait for that market correction, and hopefully investors will wise up to this, that you're going to have almost like a bifurcation in some of these larger corporations that are going to be able to stave this off. They're going to be able to pass on these prices, and then some other corporations or companies that are not going to be able to do so, since we're such a service-oriented economy. And typically the service sector, I would imagine, is going to be the one that you're going to have compressed margins and not easily pass on your prices as where you have food and energy and all this other jazz. But we'll see. That's just me speculating on that. Anyway, like I said, look at the CPI data. Look at underlying the number instead of just looking at the headlines, which so many people do. Look at the data yourself and come up with your own opinion or your own conclusions off of that. Because it doesn't look good. It's not good, no matter how you crack it. Look at the Fed's balance sheet when that comes out, because you'll be able to see their direction. And then we'll see what they do here coming soon. They're going to get a quarter point in there at least. I would like to see a half I'd like to see them go up. Let's pop this thing. Let's fight inflation. But, that's not going to happen. They've got to hold things as steady as possible if they want to prop up the government's debt load. It just is what it is, man, because they're essentially a private monopoly arm of the bank. It's a fascistic system. It's the chief tenet of communism, a central bank, but our central bank is run by the banks in lieu with a slight partnership with the government. In fact, just look at some of the Freedom of Information Acts. They've been trying to get this data out from them. That's just a telling sign right there. Anyway, talk to you later. Peace.